Yo, how you doing?
Greg, hey, happy after lunch.
Yeah, so State of Freight is something we do on a monthly basis, get together and talk about the freight market. It's always fun to do it live because we actually have some Q&A opportunity with the audience. So we will certainly invite you to ask questions to Zach and I about our views on the freight market. So
yeah, you guys get spicy when you're sitting at home or in your offices for Q&A. Don't be scared to ask us some good stuff here towards the end. But so let's get it going, Craig. You know, as people are coming in from lunch, you know, I've got the O-Tri pulled up. I like starting with O-Tri, tender rejection rates. I think it tells a good story. But what's, you know, I heard your interview this morning with UPS. He talked about some green shoots. Not necessarily for the truckload space.
no, he was like, he said it, and then he like, nope, just kidding.
Maybe not truckload all the way. But I actually, from this O-Tri chart, take some green shootiness, if that's a word that I can create, out of this O-Tri jump here at the end of May, early.
You know, it's funny because like May, the second half of May is usually a decent time historically. Like it's hard to see on a chart like this because, you know, it goes back to 2019 and it's hard to understand historical patterns. But you and I have been in this business a long time. I think folks that have been in it know that really the second half of May all the way through the end of June is usually a pretty good time for the freight market. It's certainly better than the first half of the second quarter. And I think this is demonstrating that the market is responding to more seasonal norms. In fact, what's interesting about it is that orange line. So the white line, for those that aren't familiar with this chart, the white line represents the 2024 market. The orange line represents the 2019 market. And we're back to where we were in 19. Now, a little bit of context to this. This is certainly above where we were. The blue is 2023. It's, you know, it's a couple, 1 and 2%. I think the low is 2.5. It's what are we at today?
Oh yeah, we're just around 4.
Okay, so we're at 4%
just
today.
about 4%.
So a little bit above where we were last year. What I think is really interesting about it is that we're back to 2019 levels.
Yeah.
This was the bloodbath, was the worst or the highest number of bankruptcies since the great financial crisis. Took place in 2019 in the trucking industry. And I think what's interesting about that is we're back at levels that sort of where we're at. Now, we have certainly been in worse conditions over the last 12 months, or 24 months even. But I think what we're seeing is the market returning to some more norm, and I think that's a positive sign. One of the other things that, you know, Road Check Week was 2 weeks ago, and I think you pointed it out, I noticed it as well, is that this was the first time that the freight market responded to a market event.
Right.
Whereas before, we would have these market events and they would just like, didn't move the market. Whereas this time, a market event did actually see some reaction. And I think that suggests that the market is moving into some level of equilibrium.
Yeah, and the road check stuff typically isn't as impactful to the large fleet, large carrier, large shipper relationship as much as the smaller operators. And the tender data tends to lean, obviously, larger fleet, larger
It's
ship.
mostly contract. I mean, just for those that aren't as well familiar, and we review this every time we talk, but tender data is electronic transactions that come typically from shippers to carriers, and typically based on the contract market. And essentially what this is communicating is that the carriers are, when we have a rejection rate, it's 0 to 100%, is telling you how much percent of freight they turn down. And so a higher rejection rate indicates that carriers have more pricing power. Lower rejection rate means they've lost pricing power, lower pricing power. Anytime you see a move up, we've talked about this a lot, is anytime the rate moves up, the rejection rate moves up or down, is indicating carriers are either gaining or losing pricing power.
Yeah, and anything below 5%, 5-6% is traditionally a deflationary market.
Yeah, but we've been at 2.5 a year ago. I think one of the things, you know, I wrote an article a couple of weeks ago that talked about the likely at the bottom. I think, you know, and maybe it's the way I wrote it, but some folks took me to say, hey, we're gonna have an aggressive rebound. That's not actually what I was saying. What I was trying to communicate, and maybe poorly, is that the market is likely bottomed, and it's going to, in my view, slowly build. It's not gonna be an aggressive V shape, but it's going to come back. And we have largely probably hit the bottom, is sort of the thesis.
Yeah, it's not getting worse.
It's not deteriorating.
Yeah.
And I think that's a sign that, the market, we saw, it was a sizable bankruptcy yesterday. Mm-hmm. I heard about a carrier actually out here, and I won't say who it is because we haven't fact checked it, but a sizable sort of storied truckload carrier, about a little bit less than 1,000 trucks, was mentioned to me by someone who I trust in the audience, that said that they're in significant financial distress. And I made a comment on Twitter that we will likely see another major surprising bankruptcy sometime this year. A big name that people know. I don't know who this is. I mean, I know who told me, I know what carrier they were referring to here, but there will likely be a big bankruptcy by the end of the year, because what's happening is that these balance sheets have been destroyed. Mm-hmm. And these balance sheets, regardless of whether the market improves or not, are still in pretty rough shape. And that's not going to come back quickly. And you also have high interest rates that carriers are heavily dependent. I don't think that the lenders are wanting to renegotiate the debt with these companies that have been losing money.
Yeah, I think we've read a lot of articles lately too about the fact that a lot of banks are tightening their lending practices, largely due to the fact that they're obviously more risk averse.
Yeah, I did BMO.
Yeah.
I mean, John Kingston, Mr. Kingston, John,
Yeah.
wrote an article. Yep. He loves tracking the BMO data.
I love it too. It's great.
The old Bank of Montreal data
Yeah.
that looks at truck lending, and the amount of reserves that they have put in for defaults, the amount of defaults and the reserves, because essentially the reserves should be ahead of the default rate,
Right.
Mark to market, and essentially they have reserved. John, real quick, was that back to 2019 levels, the reserves?
No, actually since BMO acquired the business from GE Financial in 2015, this is the highest ever.
It's the highest ever? Highest ever by a lot in terms of reserves. So that tells you that they are certainly getting ready. And remember, 2019, the bloodbath of 2019, a lot of those bankruptcies happened in the second half as the market actually was recovering. In fact, Celadon, at the time, was the largest I think it's still the largest truckload bankruptcy. At the time, was one of the largest bankruptcies in trucking history. It was certainly the largest truckload bankruptcy. Did not happen until December of 2019.
When those rejection rates were popping.
And now Celadon's story is very specific to some accounting fraud it committed, but it could not recover because of the conditions of the market, and it ended up ultimately folding, as we all know.
Yeah, and going under. And I think that's a good point, is that even as the market looks marginally improved from a transportation service provider standpoint, it's not like a fruitful place for transportation service providers at this point still.
No, I mean, look, it's, when we're talking 4% rejection rates, we talked about, you said 6%. I like to say 8% is a healthy market. We're subpar there. But this is a condition where, and one of the things that we've talked a lot about, but I think we should review it for a second, is that a lot of carriers, I think it was JP Morgan or Morgan Stanley, one of the two, wrote a piece that most of the miles ran by carriers is at a loss. And in fact, if you go look at earnings reports this last quarter, it was the worst earnings season since the great financial crisis of all the publicly truckload carriers. And what it is telling you is that no matter how well positioned they are as a carrier, they're still doing poorly. And these are if you're public, you're arguably among the most efficient carriers in the market. Right. And so you should be doing better than the average. And you imagine that if you go downstream from there, there's a lot of carriers that are in real trouble. Heartland is a great example of this.
Oh, wow.
For those that don't know Heartland as a carrier, growing up in the trucking industry, Heartland was always viewed as the most capital efficient. They had no debt, they did no acquisitions, but the best operator in the market. In fact, at the time, blew Knight-Swift away. They were operating in the low 80s, incredibly profitable as a carrier, and it was the model. They did a 105 OR. We're talking about a profoundly change in direction, and that's how this stuff can sneak up on you.
Right, and of course they acquired two.
They've acquired three major carriers, Interstate, Gordon, and who else did they acquire? Was it CFI?
CFI.
Yeah. So, and look, I think what's interesting about that is, if you go back in history, it was the long haul carriers in the 90s that actually were among the most profitable.
Right.
Had the best operation, because they could run, CFI and Celadon ran that north-south. They were all auto predominantly, and they were long haul, but they were very profitable in that north-south. It was the CRSTs, Covenant, and US Express that ran that west to east lane. Yep. And they were able to put teams on their trucks and run them for many, many miles. J.B. Hunt and the railroads and the brokers destroyed the profitability of that entire long-haul business model, because intermodal really took that share. Right. And those carriers have never recovered. In fact, Covenant has basically exited its over-the-road market. They're hauling chickens around.
Wow.
So
look out for chickens. We've been a little doom and gloomy here, but I'm actually a little bit more, like I said, a little green shooty here, especially since I know 2019 wasn't a banner year for trucking, but it looks like with us coming back up to this.
Back to the bloodbath?
Yeah, we're like, 2019 was actually a recovery year for the market. If you look towards the back end.
At the end of the year, I remember, and I went back in history as I've been doing a number of these articles and looking at what were we talking about back in 2019. And one of the things that is great about having a media business is, like, we are putting things on record of what we think. Like, there's a archive of our history. We were writing about the potential of a freight recession I think the first article was in April of 2019. Potential of a freight recession. And it was really in the summer before we said, we're in a freight recession.
Right.
And it was quite debated, by the way. This was not a consensus view by a lot of parties that we were in a freight recession. In fact, I think the ATA was still positive.
Right.
DAT was still, you're going to go out, you and Ken Adamo get to talk about this.
Right.
But there was a lot of folks that did not accept that view at the time.
Yeah.
And I think what's interesting is that if you look at where we're at right now, is that freight recession was very short-lived. It was about a quarter, maybe two, and then the market was recovering, headed into 20.
Right.
Like, when we entered the COVID year, everyone was talking about a 2020 strong market, or a relatively strong market in a rebuilding year, and COVID changed everything.
Right. Yeah, and that was the catalyst. And I think that's the trigger. Like, we look at these, the previous years coming out of these recessionary periods for the freight market, as we call them. There's always like a catalyst that triggers it. But before that catalyst is stuff like this, where there's a big exodus of supply and capacity leaving the market before the catalyst. And those are never predictable things. So,
well, like, I think we've never seen a freight recession like this one.
Right.
And I don't care who you tie it to. I mean, J.B. Hunt was here in the room earlier. Shelley Simpson has said as much. You talk to anybody who's been around this industry for decades, they will tell you this is a very unusual market and unprecedented recession. And I think so many, including myself, have gotten it wrong about how long it would last.
Right.
And I think the problem is that any recovery is going to be very slow.
Right.
And that's going to take out a lot of carriers. And remember, at the end of the day, truckload carriers can lose money on a per mile basis and stay in the game because of cash flow.
Right.
Like, it's when their trucks start breaking down that all of a sudden, that's when they have issues. And that's when we will see them exit the market.
Yeah, and they lose their residual, they're depreciating assets.
They do, and typical trucking company will hold on to it 3 to 5 years. And when you have the age of the fleet, where 2019 was sort of the last major, it was pre-COVID, that would be the normal cycle. The trucks for a lot of these carriers are pretty old if they haven't replaced them by now. If they're having financial difficulties, chances are they didn't buy a new truck.
Right.
At least not in the last 12 to 18 months. And they probably didn't get allocation during COVID. And so a lot of those carriers we're pretty late in the game. We start seeing some of that capacity leave the market.
So it's going to change. This too will pass. Let's go to the next chart here. And I believe this is the NTIL. Looking at the eye chart here. Yeah,
It is?
Yeah, this is the NTIL. The spot rate excluding fuel. Now, just like the rejection rate, we're seeing rates. Now, rates are above 2019, but I think that's expected due to inflation and the cost structure. The carriers have a higher floor, arguably.
30% cost increase.
Yeah.
And like, where does that come from? It's driver wages. I hope that everybody in the room understands what's happening there.
Yeah.
Driver wages are way up. Equipment cost is way up. Fuel, this doesn't have fuel in it, has taken it out, is a factor, but that's another sort of element. So you have all these cost increases and capital, and a lot of trucking companies finance at least their receivables, if not their equipment. And so they're in a situation where they're paying much higher capital expenditures to stay in the business.
Yeah, and I think for me too, the big nuance here is that the spot market has become overweighted with utilization freight, below cost freight. Like a lot of it is now simply there just to get you moving somewhere else.
They got to keep miles on the truck. It goes back to what we said, is that they will operate at a loss on a GAAP basis.
Right.
But generate cash flow to stay in the game. And effectively what they need to do is they need to cover their driver salaries. If they're owner-operators, they just need to pay for fuel, like fuel being food and fuel. And that's effectively how they need to operate. If they're a fleet, they need to pay driver wages and fuel. And so as long as they cover that, they can stay in the game.
Right.
Like, they can live to fight another day.
But talk about this, because of the nature of spot rates, and a lot of people use spot rates as targets for rates, like in general, for long-term rates. What is the risk of looking at the spot market right now and saying, that's my target rate from a procurement standpoint?
You mean for a shipper?
Shipper, broker?
Well, I mean, I think everybody is looking at spot rates and saying, I could be buying capacity at that rate right now. And I think what is happening is that this recession is so long that people are effectively giving up on a recovery. And they're saying, I've got to ensure I have freight if you're a carrier, and I'm going to take freight at these suboptimal levels in the routing guide. And I think what's going to happen is if the market turns, it will at some point turn. And if it turns in cycle, you're going to see exactly what we saw back in 2020, is they're going to start just all of a sudden not picking up freight. Now, I'm not saying that is likely to happen because the market's going to, like, all of a sudden it's going to be a recovery. But I am certainly saying that if I'm running an asset carrier, I probably am bidding freight that I'm not planning to pick up if the market turns. Like, I don't know how, I mean, you were in pricing.
Oh, yeah.
You spent years in pricing. How often did you price freight in down markets thinking, I'm going to take the $1 a mile load of beverages because it's better than nothing?
Oh, I argued with our sales team to no end to not continuously price freight to fill up a truck. Because if you price everything to fill up a truck, the path to the end is the same. You go out of business. It's just you're extending that path a little.
Cash flow, right?
Yeah. So it's not a sustainable world. Like, one of two things have to happen. The carrier goes out of business, or something else comes along that's better for the carrier that pulls them out of the muck. So to me, targeting the spot rate right now is a very dangerous game. Like, if you're thinking about, hey, I'm going to look at...
On your targeting contract spot.
Yeah.
Well, what is the spread between the two?
Well, let's look.
I mean, I think
I'm gonna skip
this
through.
is, do we have rates, or did you?
We have rates, because
Thank
I know you love
So,
rates.
I love rates. It's a simple chart, and I'm a simple person.
This is rates 12, though, so it excludes the fuel.
Well, it does. I mean, at the end of the day, it's
Yeah.
spread. The
spread's
chart will look identical. It's just where you base the fuel price. But 71 cents a mile. This is. Are you sure it's
It's rates 12.
rates 12?
Or no, it is. It's straight rates.
It's not rates
I'm
12.
sorry, I misspoke.
You want to explain what those two are?
Yeah, so rates is the difference. It's spot rate less contract rate. And in this situation, it excludes fuel entirely. So it's basically telling us that the spot market rate is 71 cents below the average contract rate. And that's a huge spread. If you look at the red there, in 2019, we were what, 20
35 to 50
yeah,
cents
yeah.
a mile. But one of the things to keep in mind is that if it's green, it shows that the spot rate is above contract. Anything red, and you're largely in a normal market. If you can look at this and call this normal, it's going to be red. Spot is typically, and that's really where a lot of the brokerage margin lives, in the delta between contract and spot. This is a great way to sort of see it. I do think one thing that's really interesting, Zach, is almost all the way through 2023, really since the freight recession started, we saw very unusual levels of spread. Right? The spread was incredibly high, and you could see that right there, really from May to really July of last year. For a year, we lived in suboptimal sort of spread, and it basically, the market was not going to reset.
Right.
We are getting closer to more normalized conditions, and this is one of the indexes that I look at to determine whether the market is headed into equilibrium, because effectively, the contract and spot rate, as the market starts to perform in a more normal sort of fashion, they should converge closer.
Equilibrium.
That spread should come in. And I think what we're seeing is a sign that we are bleeding off some capacity. It also says that we're not out of the woods yet.
Right.
Like, this is also what you would read into this, because you're not in that 35 to 50 cent mile spread. But as we get closer to that, I think and we saw it like earlier this year. I remember in January, it was like, wait a second, the market has recovered, and we were wrong. But it is increasingly showing some level of.
Well, it's sensitivity. It's getting more sensitive to things. The winter weather situation in January is largely what created that. But these increasing levels of sensitivity to me signal that we're no longer back there in July, which looks like the bottom of the market, July of 2022. That's after everything collapsed.
On the rate spread.
Yeah, on the rate spread.
The May of 2023 was the OTRI.
Right.
OTRI and NTIL.
Yeah.
Both were in May of 2023.
And this just tells me that we're moving towards equilibrium from the
We are.
numbers.
We're not there yet.
No,
but
we've still got a long way to go.
And I think the question that is on everyone's mind is, when are we going to see normal conditions? So you're going to go up against Ken Adamo.
Yeah.
And I'm going to put you on the spot. He's got the advantage of actually watching. Like,
Yeah.
In fairness, we have the home field advantage in this room, so I take a little bit of that.
I'm going to totally like switch my side if I have to.
You're going to go the opposite?
Yeah,
You're just
I'll
going to
totally run over my
But
integrity.
The interesting thing is, he gets to watch what we're saying. But I think everyone wants to know, when is the market going to go back to normal? And I don't know that there is a normal.
Right.
But when is it actually going to feel like carriers have some pricing power?
Yeah, more than likely, the market isn't going to just like ease on in. There's almost always been some sort of moment that we're easing in and then trigger. And that trigger settles out.
So let me ask you this. Hurricane season.
Yeah.
I know you're a weather dork, by the way.
Yeah.
Weather nerd, can I say that?
Yeah, absolutely.
Right.
I will lean into that.
Zach and I went to high school together, best friends in high school. And he would go home and watch the Weather Channel. He was like totally nerded out, so I can say that. You love watching the Weather Channel. The National Hurricane Center has provided a forecast, and they said this is an extreme forecast for a hurricane season, unlike any that they've ever written.
The Atlantic
I
is
think 25 named storms, I think, this year, of which, 8 that are Category 3 or above?
Major
Hurricanes. One of those is bound to hit the U.S. if their
Right.
forecast is correct. That could be a market catalyst.
Well, Harvey was the catalyst.
Indeed.
Or one of the catalysts in 2017.
Well, I mean, the market was pretty anemic in 2017.
Yeah.
It went from really challenging conditions in 16 to started to sort of come back into balance in 17. And then Harvey hit and blew up the entire third quarter and fourth quarter of that year. And that took us into 18, which was one of the best first halves in trucking history, followed by the freight recession of 19.
I mean, that's kind of the story, though. We expect this, like, I think, for me personally, I kind of existed most of my trucking career in a pretty stable growth environment. Like, after the Great Recession, the economy and the freight market were actually
Relatively stable.
Really, like, the seasonal pattern was almost like a
Because the Fed wasn't
cardio.
putting a ton of capital into the market.
No economic stimuluses came out. There was no COVID.
You know, the Obama recovery was largely, the lack of a fast recovery is largely blamed by economists on the lack of monetary stimulus.
Yeah.
And then all of a sudden, really for the last 9 years, we've gone the opposite direction.
Oh, if you looked at the charts, like if I had a historical chart of the last 10 years, or actually 15 now, good grief, it goes from like this easy little seasonal up to the right uptick with rates and demand to this chaotic, like you would put them in the hospital.
So why is that? Why do you think that take the Fed out of the picture, which is important, but let's talk about trucking specifically. Yeah. Why has the market been so volatile over the last 10 years?
It's been overstimulated twice.
Okay, that's so Fed policy,
yeah.
Right?
Well, you've had
but the freight market
cuts.
itself.
Yeah, the freight market itself went into an industrial recession with 2015, 2016, and there was an extended period of kind of like nobody really knew that we were in a freight recession in 2016. I personally didn't know because there was no real good external data source that gave us that indicator at the time. There were a few out there, but it wasn't like overt. Like we're really familiar with the tender day to day. But I remember talking with our CFO, and we looked around the room at ourselves and said, "What are we doing wrong? Like our service is not changed, but we don't have the volume." And then 2017, in the middle of the year, I remember calling, actually, literally I was talking to somebody at FreightWaves, Mike Vincent at FreightWaves, and we had a record June in 2017. And I went into a bill audit mode because we had absolutely changed nothing. Record revenue June 2017. And it's just like, oh, produce season. It's pulling all the trucks out of Atlanta. Sure enough, I checked the line haul rates that I was about to get in trouble for. $4,000 going from Atlanta to Dallas, which averaged at the time around $1,500 for us. So we had a ton of money sitting under there, and we were LTL. And record revenue, but the profitability wasn't exactly.
Because you're having to buy stuff on the
yeah.
spot market, and you're having to pay crazy rates. I have a theory that the volatility has been caused by the freight brokers. Like half the room is freight brokers, so I'm going to say this. But I think the proliferation of freight brokerage has created a day trading mentality in the market. And because you have participants that are constantly trading in the market, that is causing a lot of this level of volatility that is unprecedented for it. And you can go back in the data. In the year 2000, according to Armstrong and Associates, 6% of the trucking market was moved by brokers.
Yeah.
And 2009, it was something like 10%. 2018, it was around 20%. Triumph has said they think it's as high as 50% of trucking freight is moved through brokerage. I would say it's probably closer to a third. I don't know if it's half, but regardless, we're arguing about whether it's 30% or 50%. It's a lot of freight.
Can it be both?
What do you mean?
Can it be economic?
Well, look, absolutely,
Yeah.
you have economic stimulus.
Yeah.
You have
Because
Trump's,
I agree
You
with
have Trump's tax,
Yeah.
like it wasn't monetary policy, it's fiscal policy.
Yeah.
You had Trump's tax tariffs. You had Trump's tariffs that did this whip slash thing in 19,
Yeah.
18, 19. And you had Trump's tax cuts that happened in the first part of his administration, 17,
16,
that really
17, yep.
stimulated. So yeah, absolutely,
Yeah.
you can have that happen. But in the backdrop of what makes this market so volatile, so take the demand side of it, we should pull up volume, because the volume is only one part of the equation. What is causing all of these market, the ability for small carriers to operate? What has created this expansionary market? It is not consolidation. In fact, one of the crazy stats, and I don't think you have the chart, is the idea that so many people have said for really my whole life is that the market is consolidating. The bigger carriers are getting bigger. And like they see these big transactions, US Express, Knight Swift, and they say, oh, these mega mergers are happening, it's consolidating. And you see this on social media where they're like saying it. If you go back to 2010, the percent of capacity that was held by the largest carriers was about 52%. And I think it's over 1,000 trucks. If you go look at it today, that's around 42%. The largest segment of trucking is that 0 to 6 trucking company. It's the really smallest guys, are now the largest part in terms of the total amount of capacity. They are gaining market share. The market is not consolidating, it's fragmenting. And who is supplying all that freight? It's the freight brokers. And look, we love brokers. I'm not here to judge. I'm just saying this is an inevitability of this market.
Yeah.
And I think volatility is going to increase. It's not going to slow down.
I 100% agree with you. I think we can both be right in this situation because the more participants you have in a free market, the faster the market moves. The financial markets are the perfect example of this. You got the quants that are up there ingesting information daily, and they are literally driving rates up and down as they ingest information so much faster. The brokers are the information ingestors in this environment.
They're the day traders.
And they are the ones really moving the needle on this. And I think you wrote an article on this, and that was actually a super eye-opening article. I quote it all the time, by the way, on the capacity growth in the truckload market comes from the 1 to 6.
Yeah.
They exit through the 500 plus. Like they manage their fleet size and scale it down. If you looked at all the largest fleets, they've all contracted over the last year.
Yeah, and I think but the reason that they're able to do it and they didn't do it in 2010. And you think about, there's a component about rate. Everybody talks about rate. Everybody thinks about rate because this is something we feel, right?
Right.
We see it. It hits our pocket. But what we don't talk enough about is the amount of volume that the small carriers are getting. Because back in the old days, when I was active in the market, what would happen when the market would slow down is that the smallest carriers would lose their position in the routing guide. They would effectively, the shippers would say, we only want to work with core carriers and we have 100 core carriers today. We're going to get down to 20. And they would do this sort of game of like trimming the routing guide because they want to consolidate the number of relationships. And they would do this when the market was soft. And they would preserve the largest carriers because they knew that they had capacity. Like the mid-sized and largest carriers are the ones that they could depend on because they had the trailer pools, they had all this stuff, and they wanted to keep them in the game. But what has happened is that brokers have entered the routing guide in a primary position. And now shippers can say, I only want 20 core carriers, period. I don't have to do this game of expanding my number of core carriers. I can keep it at 20, and when I need incremental capacity, I can call up whomever, named broker. And that is what is supplying the small carrier, and that is why they're surviving. Every single CEO of a public company, trucking company, and this is freight brokers as well, but certainly the asset carriers, has gotten it wrong about how long the downturn would be. And they all said it's because we're gonna see these guys turn out. Derek Leathers at Werner said this 2 years ago, that this is gonna be a short-lived recession because they're all gonna go, we're gonna lose a lot of this capacity. They're still here.
Yeah.
Someone is keeping them in the game. It is the proliferation of freight brokers. So I guess the message out of that is that this is a permanent fixture in our business. That the volatility that we see, the longer cycles that we see, whenever you see hyper conditions, it's going to create a lot of new entrants into the market really quickly. And the downside of the market may go on longer than these up cycles, and that may be a permanent fixture. It's a really depressing story if you own trucks, by the way.
Right.
But it is a reality that we have to face. And I think that is something that this industry needs to come to grips with.
Yeah, I think too, a takeaway for me from this, I've got OTVI pulled up, which is our outbound tender volume index. It's a measure of demand. It's a fantastic macroeconomic indicator for goods demand as well. And a lot of the story has been, well, demand is down. Well, that's one side of the equation in a lot of cases. But if you look at this chart, seasonality chart, and I left the COVID year in this one, I took it out of the others, just to put some sort of perspective here, but demand is up significantly over 2019. It's up significantly over last year. And demand has not been volatile, relative.
Demand.
Outside of the COVID
You made this
stuff.
comment years ago when we were talking about OTVI, I think 18 or something, you made it. And you actually talked, this is like a heart rhythmic monitor. By the way, just so everybo's clear, those big dips are holidays.
Yeah.
Just so you're clear. But if you look at it outside those dips for the holidays, it's a pretty, you have year-over-year improvements. but it's a pretty,
Stable.
like not, like it's
Yeah.
stable. Exception of the COVID cycle, and you can see the dramatic changes and whipsaw there. But I think what this is telling us is like, volume is not the problem.
No.
And that is the news to everybody. So it is definitely a capacity problem. We talk about this every time we get together. I mean,
Right.
the question is how long is this gonna go on?
Yeah, and you know, if I left 2018 on there, 2019, the freight recession year, demand side, I remember us having this conversation in 2019 because OTVI was not actually down.
No, it actually, I think it was up a
It was
little bit.
a little bit
yeah.
up, and we were like, what is going on? This can't be, you know, because we all kind of naturally just think, equivocate demand.
Volume, because
Yeah.
I'm not seeing the volume,
Yeah.
therefore it must be bad.
And it's because supply and capacity is so opaque, and it's hard to measure, especially at the small carrier level.
Yep.
But that's competitive units. So demand, I mean, do you see, I mean, to me, this has more of a downside risk later in the year than it does an upside.
I agree. I think there's, I mean, look, let's take UBS's conversation this morning about green shoots. I think there is certainly, it was interesting to hear UPS talk about the fact that consumers are strong. I mean, he was very assertive about how strong the consumers are. That has been the shocking story of this last 2 years, is how resilient the consumer has been.
Right.
And every time economists, we've talked about it, every time we come up with a reason why consumers will roll over, they don't.
They're throwing it on their credit card.
But why?
what it looks
Why
like.
do you think that is?
Yeah, it's because, I mean, I think a lot of the macro data is lagging, and I think a lot of the policy has a slow impact on a lot of things. And I think I think we're seeing a lot of these trends manifest at high levels, but I also think we have a polarization going on. We got a lot of inequality build over the last couple of years with the COVID stimulus stuff. You got a lot more up here, and there's more down here.
Yeah, it was interesting. I was talking to actually Jonathan Hoffman, who will be here tomorrow, and he's at College Charleston. He worked for the Pentagon before he joined the College of Charleston, and he's renting a house in Charleston, South Carolina. And he's like, the house is, to get a house that could fit his family, it's like $1 million, like a nice house, but it's like $1 million on houses that 2 years ago were $600,000. He's like, we're renting because we can't afford to buy. And I think it's almost as if we're living two different economies. If you own a house and you finance your housing payment at 2.5%, 3%, 4%, whatever, you're doing a lot better than someone who's renting. And I think that's the dichotomy in the economy. It's not so much the poor versus the rich. It's the folks that own versus rent.
Yeah, and the housing market, of course, I saw an article on this. I think it was either the Journal or Bloomberg One, where talking about the younger generation is kind of like last person out at this point, like in terms of owning a house. They're not.
Yeah, they probably won't get the opportunity for some time.
Much longer period of time, especially with interest rates being where they are. So, to me, I've talked to a lot of economists, and I'm not an economist, and I'm not going to play one today, but I've heard from several of them that they can actually make strong arguments to both sides and cite data that we're in an economic recession right now, or we're actually doing great. And it's because there is a lot of polarizing information out there. There is a lot of...
But don't you think what's driving the employment market is the government stimulus, not the consumer stimulus that goes, well, I should take that we have student loan deferments or forgiveness.
Well, the debt levels are going up, and so are the...
But it's a lot of that infrastructure bill, it's the Inflation Reduction Act. I talked this morning about the stimulus that's going into the auto sector.
Yeah.
A lot of that is, it's interesting because economists that I follow have talked about the fact that the Fed is trying to pull in and rein in the economy, and Congress
is trying to spur
and the Biden administration are doing the opposite of funding these huge bills. And a lot of that is sort of exhausted, right? Like we've started to see a situation where Congress is not putting out new big stimulus bills. And as that starts to fall out, as that money starts to trickle less and less of it, you could be in and you asked what the risk is, that's the downside risk to volume. Is like all of a sudden, if we start to see consumers falter, then volume could fall apart. So there's less risk on the volume side of it rapidly increasing. I think you'd be hard pressed to make a case that I would subscribe to about volume significantly increasing.
Yeah.
Whereas the downside risk is that it significantly decreases.
Yeah, I think there's a little bit more to that. The, you know, to me, like, you know, the late year situation is nearly unpredictable at this point. Like they've overachieved. The consumer overachieved from most of our expectations. I remember us talking about this last year, and they're doing it. So for me, I'm looking at OTVI, I'm like, everything's fine today from a demand side.
I mean, it looks strong. Look, you heard it from UPS, and you know, what's interesting about UPS, FedEx the same, is they don't put out a lot of like information in between quarters, but it does tell you a lot about how consumers are sort of playing out because they see that stuff in real time.
Yeah, and speaking of demand, well, here, you know.
This is a great chart.
This chart has to be talked about first, I think. I was gonna go on to the maritime side a little bit because I think that's interesting. Outbound tender volume index in the greenish yellow, and you've got carrier details, total trucking authorities up there in white, and you're looking at it on a relative chart. So total truckload authorities, operating authorities, have grown 39% since 2019, 5 years ago at this period in time, whereas tender volumes are up 13%. So when we tell you that demand has actually grown, it's grown less so in the context of supply. Now, this is not a one-to-one relationship, and I'm not trying to make it that, but I think the direction is something valuable here. But the alligator mouth is closing.
It is closing, and I think what we want to see is those get closer and closer.
I don't think they have to cross, do you?
They don't have to cross, but I think what you want to see is directionally it continue to do it. That tells you that tomorrow should be better than yesterday, at least conceptually in terms of capacity, if volume stays robust. And if that happens, at some point, those two are going to get closer and closer, and that's when it will start to feel much healthier for freight. And I think you can make the case, and I'd made the case that the second half is certainly going to be better than the first half. I think next year, assuming that the economy stays fairly strong, and the world doesn't end when the election happens, then I think we'll see a situation where next year could feel a lot healthier for carriers.
Right. And I want to go ahead and say, I think we put out mics for people to ask questions.
Do we have mics?
Do we have mics out here? Okay.
Okay, cool.
Right. So feel free at this point. We'll keep talking until somebody wants to ask a question. And Pickett, tell me. Or Kingston, tell me.
Can I call on somebody?
Oh, here we go.
Okay. Yes, sir. It's hard to see.
Yeah, I am Matt Clark here from Atlanta. This is a good slide. I appreciate it. So to follow up on this, and Craig, you mentioned about costs going up, driver wages going up 30%. You know, how can those smaller carriers hang around for so long with costs going up, rates down, and you know, when do you see this excess capacity coming out? I mean, I don't think people have talked about that it's not coming out, hasn't come out as quickly as anticipated. You know, why is that, and when does that start to ramp up?
Yeah, I mean, I think it goes back to a couple things. One is I think what we've talked about is that brokers are keeping these guys in the game a lot longer than they used to do, just because of the nature of the market. They can operate at losses for a long time as long as they're generating positive cash, some cash flow. And what they're sacrificing is that equipment. Like, they're just not buying equipment and replacing. You know, they may be on a 4, 5, 6-year-old truck that they have paid for, and until they need to replace it. And maintenance, anyone who's been around trucking knows that what happens as your trucks get older is you start to defer maintenance and you start to not maintain the truck. Your operating costs naturally go up. You start having more breakdowns, and you have more safety issues. In fact, insurance carriers will tell you that one of the biggest indicators of accidents and predictors is the age of the equipment, because it suggests that a carrier doesn't have the finances to manage the equipment. Also, the better drivers are not going to run some ratty rig, and they want the good stuff. Right. And so that's a reason I think these guys are hanging out longer. One of the things, I talked to the Federal Reserve not too long ago. They had these roundtable dinners, and we had one in Chattanooga. And one of the things that came out of that conversation is the idea of homelessness that's really ravaging a lot of cities. And it's going back to that renting versus owning thing that's happening. And one of the things that we talked about, there was a number of freight, Chattanooga being the number one freight city in the country, Matt. One of the things they talked about was there is a portion of the driver population that no longer have a permanent home. And they're actually living day to day in their cab. And you think about how long you can survive doing that. If you don't have a housing payment, you can live a lot longer in this industry and stay a lot longer than you otherwise would. And so while no one has measured that data specifically, the homelessness population in America is a major issue for the Federal Reserve and really policymakers. And it is not just an immigration question, it is people who have been left out of this, this rent versus own equation that is actually causing some of that. And that is probably keeping some of these carriers that drivers that would have otherwise left the industry in the industry longer than they otherwise would. The other thing to look at is housing starts. A lot of the trucking industry drivers there's a high correlation of the population where truck drivers also happen to work in housing and construction jobs. And as we've seen housing slow down significantly, that's also kept more drivers on the road. And ultimately, this capacity question is a driver question.
Yeah, right. In terms of, I talked to Dustin Bach, and he's a tank, shipper operator, and they're already running into some level, and it's a lot harder in tank, especially with chemicals, to source some of these drivers. So all it's going to take, and they're insulated from the larger market in general, but it does not take a lot of energy for them to feel the driver pinch there, because the requirements for the drivers are a lot harsher there. Again, great question. Keep the questions coming. I can't see the audience very well, so somebody.
So Matt, you want to ask a question? I know you do.
Oh, here we go.
If it's about Chicago, the answer is Chattanooga.
Well, the first question was actually why this is in Atlanta, if Chattanooga is the best spot. No, all right, real question though. What are your predictions in terms of brokers in the second half of the year? You've always been big about making some sort of big outlandish prediction. Would love to.
Outlandish?
No, I'm kidding. But would love to hear your predictions besides the large trucking company potentially.
Yeah, I mean, look, ultimately, as the spread ends up compressing, that is the most difficult part of the cycle for freight brokers. And the reason that is the most difficult part of the cycle for freight brokers is, particularly the large brokers that have participated in contracted freight, is that their ability to buy in the spot market is they're having to pay up for capacity. So that spread, while volumes have been slower for a lot of freight brokers, they've actually done okay on a margin basis because they've been able to buy to the spot market and play some arbitrage game against the contract market. But as that spread compresses, that's when we could see some significant issues. One of the things that isn't talked about enough is last year, I think we saw 4 freight brokerages, sizable freight brokerages file bankruptcy. Surge, obviously Convoy was one of those. And I remember talking to one of the big factoring companies, and the CEO goes, he's been in this business for many years, he's like, I've never seen a sizable bankruptcy of a standalone brokerage without assets. And we saw 4 of them last year. And I think what we could see, and a lot of what happened during the boom cycle is they went out and took these lines of credit to finance their growth, and there are covenants that are tied to the margin. As the margin compresses, that may put them in a position. Now, they've had a year, 18 months, perhaps 24 months to work themselves out. I think Convoy was a wake-up call for everybody.
Right.
Because everybody's like, dude, like it could happen to me. And Surge as well. I think that's probably going to help sort of solve some of that problem. But I think, Matt, you know this game as well as anybody, that as that cycle and as spot rates increase and contract does not, we see that rates compress, that we should see more challenging on the brokerage side.
Yeah, you look at C.H. Robinson's stock price, it actually correlates with, it's at its highest point when the market deteriorates from
as it starts to deteriorate, you see it really peak because their margins rapidly expand, and then as the cycle turns the opposite way, they see significant compression. It plays out every time. And so it's a difficult market. We've got a question right here.
I had a question. Jonathan Gerkink at Pittsburgh Data. I wonder if you could talk a little bit about global trade and kind of the realignment that we're seeing there. politicians potentially competing with one another to see who can raise tariffs higher and how that's affecting the industry, what you've seen the data so far, and any speculation on going forward?
Yeah, it's a great question. I mean, we've talked about it this morning. I think one of the big stories of this decade, when we look back in 5 years, is going to be the cross-border trade between Mexico and the US. And Mexico and Canada. Yeah. I mean, Mexico, Canada, the United States, the North America sort of story. That is going to be the big story. And I think a lot of it is what you are seeing is US companies putting significant investments in Mexico, but you're also seeing Chinese companies make significant investments in Mexico to be closer to their customers. It's a resiliency game. A lot of these Chinese corporations realize that there's going to be geopolitical issues, and they are using sort of a modern silk, that whole road and belt thing to sort of be there. And I think having physical presence is being encouraged by the government. So
yeah, and this is the import booking volume from China to the United States in white, up 29% over the last 5 years. And then you've got China to Mexico, and up 177% over the last 5 years, with the bulk of that growth happening in the last year and a half.
By the way, a lot of that freight that's going to Mexico, I don't care what UPS says, a lot of that freight is coming to the United States.
Well, Shine, I think literally.
They don't want to make a big deal out of that, but I promise that a lot of that freight is being forwarded on to the United States. And it's a way of getting into the tariffs and sort of bypassing the whole tariff.
It's why incentivization's better, not regulation.
Yeah, I mean, like that's what, I think you're seeing that play out. But it is not just China and sort of zone skipping around tariffs. Yeah. It is literally the amount of money that US manufacturers and US companies are investing in Mexico and the United States is playing out in ways that are unprecedented in this decade. Yeah. Or unprecedented in the last couple of decades.
Yeah, the geopolitical risk has come right back.
It's massive.
We've been in I think you pointed it out on one of the State of Freights, that we've been living in a bubble in history where geopolitical stability has been a thing.
Like, we are kids of the Berlin Wall.
Yeah.
Post-Berlin Wall period. I mean, you and I were 10 years old when the Berlin Wall fell. And we have lived very charmed lives of relatively stable, at least in the United States, relatively stable global trade. And really what we've seen in the last couple of years is that's no longer the case. The question, I think, should be on everyone's mind is what happens. China has, in recent months, and really for the last 2 years, has been very aggressive, outwardly aggressive in these military drills. And that's sort of their pattern is almost to desensitize everybody so that they can, when they decide, if they decide to actually attack Taiwan, that it's sort of a surprise. They have to operate under Sun Tzu of Art of War, which is, almost lull your enemy into not expecting and be there when unexpected. It will be a surprise attack. We are unlikely to see it coming to the degree that it is. And I think that's why they're doing a lot of these drills, is just to test and prepare us and sort of get us to almost fall asleep at what they're doing. And that is a risk that every supply chain organization professional should be calculating.
Yeah, that's terrifying. Next question.
Yeah. So you talked a little bit about whether it's zone skipping and China washing goods through Mexico. In that growth, is that what's happening, or is what is being shipped to Mexico from China different than what they were shipping historically? Is it more raw material? Is it more part and then assemblies happening in Mexico? What's driving that massive increase we've seen in the last 18 months?
I think, it's a lot of it in terms of different products. Source materials, raw materials are coming. It is now cheaper to produce in Mexico on a per hour basis than it is in China, which is sort of an astounding fact. And so they're doing final assembly. And they're bringing those materials in from China. China still provides an enormous amount of raw materials to the rest of the world. And so some of those products are coming into Mexico. Final assembly very well may be Mexico. Some of it's the United States. They're bringing stuff in for final assembly in the US. Auto has been auto's a pretty remarkable. We just saw massive tariffs put on EVs. The Biden administration put 100% tariff on cars, electric cars. because they are very fearful. I sat down, this is a couple years ago, with the head of JD Power, and this was before it was on many people's radars. It certainly wasn't on mine. It was 2017, and he made the point, I don't know how many EV manufacturers, OEMs are in China, but at the time there were 270 EV car manufacturers in China, and he said there are only 4 major internal combustion manufacturers in the United States. And he's like, they're going to clean our clock. They cannot compete with the West in internal combustion engines. They don't have the engineering sophistication or knowledge base to do that. That's really the West. But they have leapfrog around EV, and I think that's why the Biden administration has been so aggressive to really block electric vehicles. And by the way, these electric vehicles, I don't know if you've seen some of the videos, are badass. Like, there are cars that I think everyone in this room would want, and they're fairly cheap. Like, there are some really awesome, like, automobiles. These are not Chinese, cheap Chinese imports.
I don't have an EV, but I've been in one, and they're fantastic.
Yes, sir.
Hey, hi, Zach, Craig, Angel from Intelicargo, based in Puerto Rico. I got a quick question for you guys. I would like to hear your feedback and comments on the latest Federal Maritime Commission ruling on the detention and the mortgage billing practices.
Yeah, I mean, I think, you know, we have, I don't know if we've been critical of the Biden administration, but I think one of the things that you can at least be complimentary of is that the Biden administration, and largely due to the massive excesses of container prices that came over a couple years ago, has actually identified a lot of the monopolistic practices of the ocean container lines.
Yeah.
And I think what they have rightfully identified is that that is a substantial tax to consumers. One of the risks here is that they seem to have, there is a focus for that, but it's not getting a lot of attention. We're not hearing, you know, Biden and his administration are not doing press conferences about some of these practices that are taking place around the ocean, international ocean.
Well, we've got the ocean rates up here, and you know, I watched Zanetta give a presentation about how the you know, the conflicts are really helping fuel some of this, but that's in lieu of capacity growth as well.
Yeah, I mean, look, it's interesting, and I asked the question this morning, and he had a smile, but he couldn't say it as a UPS executive, because he's dependent upon them,
Yeah.
that they're clearly exploiting the situation.
Yeah.
And the pricing that we're seeing does not necessarily match up to demand. They're taking advantage of these circumstances to really drive a lot of pricing. I mean, one of the astounding facts of the container market is, first of all, of the top 10 carriers, not a single one of them is a US-based flagged carrier.
Right.
The top 10 carriers own 90% of the capacity of ocean container freight. That, if you compare that, and we clearly understand that OPEC is a cartel. OPEC has 40% of oil, the global oil supply is the OPEC countries. And we know how much they control the global oil markets, or have historically controlled the oil markets. You don't believe for a second that the ocean container lines, as 90%, that are not subject to US antitrust law, like they're exempt from that.
Yeah.
You don't believe for a minute that they are not using everything in their power to control pricing? And I commend the Biden administration for actually making the point, and hopefully they'll follow through with it. And we'll see what happens, you know, in the election if that continues. Yes, sir.
Hey, it's Emery from Portex. Do you guys see a future in electric semi-trucks? Going back to
Class
EVs?
8?
Yeah, Class 8.
Nope. I mean, yes, 10 years from now. In local delivery, maybe, but you know, Ryder did this study. Shelley Simpson talked about it a week ago at JB Hunt. The EV, the over-the-road EV, is not economically viable. So the most successful electric car manufacturer in the United States does not yet have the capability to mass produce the semis. The Tesla semis, and I know Dooner's, I can hear the cowbell somewhere. We track we get these from drivers of the number of tow trucks that are towing the Tesla Semi. And I think we're up to like 15 or something of different trucks, because you can see them. Those trucks are not commercially viable right now.
Right.
And the problem is, it is an economic problem and is a physics problem. They're heavy, they take an enormous amount of charging capabilities, and it's just not economically viable. I think Ryder's study said it was like 2.5 to 3 times the amount of cost on a per mile basis. So the promises of electric trucks sort of being cheaper than the diesel truck just isn't real.
Also, the infrastructure in there.
Infrastructure is a major problem. And ultimately, make this last point is, commercial trucking fleets buy trucks on 2 factors: total cost of ownership, which means they need to have absolute certainty that it's going to be efficient to run, and dependability. And we have yet to see a dependable Class 8 truck that can stay in market and compete against a diesel. So it eventually, I'm an optimist, and technology will eventually overcome these issues, but it's not gonna happen soon, and I am not bullish on heavy-duty, over-the-road Class 8 trucks. I am certainly bullish on local delivery trucks. I think the UPS model is the perfect example of that. So.
Sure. Well, we're out of time. Thank you all for watching, and stay tuned for rapid-fire demos.
As soon as you